Macaulay duration we saw. Okay, then next one, modified duration. Now you just have to, see the question and try to do on your own. See this, a 5-year 11% annual coupon bond priced at 86.59 to yield 15% to maturity has a Macaulay duration of 4.03. Calculate the modified duration of the bond. So modified duration is equal to Macaulay duration divided by 1 plus YTM. So modified duration, Macaulay duration is 4.03. YTM is 15%. Solve this now. I think that's it. Yeah, this much only. Solve it. Acha, we did this, no? In the last time itself, we did this modified duration, right? But we are doing this from the textbook now this time. Okay, done this one?
Yes, sir. 3.5043.
Yeah. Now you read this thing. This is okay. Now I just have to quickly take you through, like, because otherwise we have done all this. This is okay?
Yes, sir.
Okay. Now, if I use only, the formula that I used was change in bond price. Okay. Yes. So change in bond price is equal to minus means assuming if the interest rate is going up. Okay. So minus modified duration into delta YTM. Okay. So that means I'm ignoring what? Convexity. Convexity into delta YTM square. Okay, so this part, if you don't know, then it becomes what? Approximate change here. Okay, approximate change. Then you can read all this now. See if you are able to understand all this. Is it okay?
Yes, sir.
This is the formula. So you may just try this one now. All numbers are here directly given. That if the yield goes down, this is V minus. And if the yield goes up, no, this is V plus value when the price goes up. Okay, and this is V minus. So the value is directly given. You have to just plug in the number. So are you able to understand this formula now?
Yes.
Okay. This is convexity. Okay. Convexity. Right. Okay. Then money duration. Money duration means overall for the entire bond position, what is the duration. Okay. So this all we have done, but you can just go through it now. This all we have done, right? Acha, here they said 25 basis point. So this is the duration, total duration. Okay, 7.42. 7.42 is the modified, acha, it's the duration into total duration. So this is the total value of the bond. Okay, which comes to this much is the duration. Now they said what is the change for 25 basis point increase. So it will be minus duration. That's why they say decrease. Minus this much. Is it okay? This part. Minus 15035. Is this okay? Understood or not?
Yes,
Is it
understood.
okay? Then price value of your basis point. Okay, you should know this articulation also. But before that, we'll do the sum. Okay, let's go through this question. Price value of your basis point. PVBP means price value of your basis point means what, you know? Price value of year basis points. That means change in the bond price for change in the bond. So here it is. Uh, Average. Okay, wait. We can is the money change in full price of your bond when its YTM changes by 1 basis points. So change in the price of the bond. Change in the price of the bond for 1%. Change in the price of the bond for 1% change. Change in the price of the bond for 1% change in the not 1%, for 1 basis change, for 1 basis point change in the interest rates. What is 1 basis point that we need to see? Okay. Change in the price of the bond for 1 basis point change in the interest rate. So change in the price of the bond for 1 basis point change in the interest rates. 1 basis point means what? See, when we say 100 basis points, okay, it is 1%. Let me write like this: 1% is equal to 100 basis points. Okay, that 1 has been divided into 100 parts, 1%. So 0.5% means what? 50 basis points. 0.25% means what? Tell me. 25 basis points. Normally, bank uses these terms. We are reducing or increasing interest rates by 50 basis points, 25 basis points. They say this. So now if I say 0.1%, that will be 10 basis points. If I say 0.01 percentage, that will be what? That will be 1
1.
basis point. That will be 1 basis points. Zero point zero one percentage is equal to 1 basis point. Okay, now 0.01 percentage is equal to 1 basis point. I can write this 0.01 percent. So here, for now, this much is only needed, but I'll just go one step ahead because that information is useful in economics. So 0.01 percentage can be written as 1 by 10,000. Okay, 1 by 10,000. So remember this one. This in economics, in forex topic, it is called as 1 pip. Pip means percentage in points. That time I will repeat again. Percentage in points. Okay. 1 pip is percentage in points. Okay. Yeah, so now we will stick to this one only, 1 basis point. Okay. So 1 basis point means 0.01 percentage. You got the idea what we are finding. For this interest rate change, what will be the change in bond price? Okay. Now go through this question. Okay. A newly issued 20-year 6% annual pay straight bond is priced at 101.39. Calculate the PVBP for this bond, assuming it has a par value of $1 million. A newly issued 20-year 6% annual pay straight bond is priced. Six% annual pay bond is priced at 101. Calculate the price value of a basis point for this bond, assuming it has a par value. Okay. So first we will calculate. We need to know what is the IY before we come into what will be the change. Okay. So for change of 1 basis point, what is the current IY we need to know. So what is the current IY? So N is 20 years. Present value is 101.39. Then
EMT is 6 and this one is 100. Right?
payment is 6. This is 100. Calculate the IY, no?
5.8799.
Uh,
So 5.88.
5.88.
88.
Okay. I'll see the book. See, they mentioned, yeah, 88. So now 5.88 means it will go to 5.89. That is 1 basis point means what? 5.89 and 5.87. So if it goes to 5.87, calculate what is the present value.
Then the PV is 101.5069.
And if it goes to 5.89, then what is the present value?
Then it is 101.2730.
Hmm.
Yeah.
Uh, yeah. So now price value of your basis point. Remember I said the formula for duration is V minus V plus divided by V0 to V0 into delta YTM. Then I said this is because twice we are focusing on change, so we are multiplying by 2. But this is the average one. This is nothing but price value of your basis point only. The formula is V minus V plus divided by V0. V minus is this one when the interest rate comes down. Minus V plus is 101 point divided by V0. V0 is 101.39. Okay. Just calculate this now. Oh, sorry. This is not V. This is okay. This is 2. Sorry. This is 2 divided by 2. Okay.
That
Yeah.
is
Just calculate this. This is not
0.11.
V0. Okay. This is 2.
That is 0.1169.
1169. Okay. Sorry. Then this was the average. Okay. This becomes the PVBP. So, this was all wrong explanation. This becomes the PVBP. I'm so sorry. This is this PVBP, and then this is the V0 into delta YTM.
So
Okay.
0.1169 is the PVBP.
Yeah,
PVP.
yeah. That means the price will change for 1 basis points. So it will change by 0.117.
Yeah, 0.117.
This will be the change. So the new price, okay, for $1 million. Okay, so the new price will be. So this is for one bond. Now in this case, in this case they said 1 million. So 1 million means I always prefer converting it into number of bonds. Okay, so if I convert it into number of bonds, how many bonds do I have? 1 million. And I know the price of one bond is 100. So I have 10,000 bonds.
10,000 bonds.
So I have 10,000 bond. In one bond, there will be a change of 0.117 into 10,000. So 1170. This will be the change in bond price. Okay. This will be the change in bond price. Okay. How they have done is 0.117 into 100, and this is the value 1 million into into 1%. That means this is 100% only. 100, no, this is not 100%. This is, okay, this is the change for 1 basis points. I prefer doing like this. This is the change, 10,000 bonds. So this is the total change. Okay. For the $1 million par value, each basis point. So this is 1 basis points change in white. So okay, because here they are using 1 million, so they are multiplying with 1 basis points. Okay. I prefer doing like this. It's up to you which way you want to follow. Have you understood this one?
Yes, sir.
Okay. So this is, so remember this part is, because before this I incorrectly said, that means this part is PVBP. Okay. This is for 1 basis point change divided by the total change happening. Okay. You can read this now. Average of the decrease in the full value. Just read this theory.
Got it, sir.
Okay. Okay. Now this paragraph, this is all little tricky one. You read the first one. Are you able to understand? This is what we have already done in that those 4-5 points we were doing right before. There it is mentioned. Let me see. Wait. Other things equal, bonds with longer maturities have higher interest rate risk. Can you understand this line? Because if you are there in the bond for longer period of time, so in the long run, which risk is more effective? Price
Reinvestment
risk
risk.
or reinvestment risk? In the long
Reinvestment.
run, reinvestment risk is more powerful. Okay, in the long run. So that one, longer maturity will usually have higher interest rate risk. Interest rate risk means reinvestment risk only here they are speaking about. Okay. The present value, okay, now you can read this further. Is it okay for you? Is it okay?
Yes.
Okay, then next one. Okay, so this is little tough. We must say usually, because there are instances when an increase in your discount coupon bonds maturity will decrease its uh, an increase in your discount coupon bonds maturity will decrease its Macaulay duration. We must say usually is highlighted here. We must say usually because there are instances where we must say usually because there are instances when an increase in your bonds. We must say usually because there are instances where an increase in your discount coupon bonds maturity. Increase in read this as one word, okay? Discount coupon bonds maturity. That means maturity is increasing. It is a discount coupon bond. Coupon bond trading at discount, but its in maturity is going up, will decrease its Macaulay duration. Can you understand this? That means if the maturity is longer, uh, 1 minute, wait, where instance when an increase in your discount coupon bonds maturity will decrease its Macaulay duration. For a discount bond, we must say usually because there are instances we must say usually because there are instances where an increase in your discount coupon bonds maturity will decrease its Macaulay duration. For your discount bond, discount coupon bonds will decrease. Okay. See, what it means is if the bond is trading at a discount, not maturity, you have to emphasize on the word discount. If it is a discounted bond, its Macaulay duration will decrease. It is like this. For a discounted bond, okay, for a discounted bond, Macaulay duration will be lower. Can you understand why? For a discounted bond, Macaulay duration will be lower. Can you understand why? Because you are buying at a lower rate. You have paid less, so it will be easier to get back the money quickly. It's a coupon bond also.
Yeah.
So you are getting coupon and also you bought it at the lower rate. So this is what this line means. Is it okay now?
Yes.
Okay. So don't focus on the word maturity, focus on the word discount. For your discount bond, duration first increases with longer maturity and then decreases over a range of relatively long maturity until it approaches the duration of the perpetuity. Okay, for your discount bond, duration first increases with longer maturity, right? And then beyond a certain point, see, duration first increases. Okay, if the maturity is going long, then it will increase and then decreases over a range of relatively long maturities until it approaches duration of a perpetuity. That means after a certain range, it comes down. Okay, duration comes down until it approaches the duration of perpetuity. So perpetuity formula is duration of a, if it is a perpetual bond, then what is the duration? So duration of perpetuity. Perpetuity means forever that bond is there, no maturity period. That is equal to 1 by 1 plus YTM divided by YTM. Okay. 1 plus YTM divided by YTM. Okay. Duration of perpetuity. I did not see any sum based on this, but you just remember that this is the formula. Okay. For duration of perpetuity. Let me just think for a minute if I can explain something more here. Duration change. I think some explanation I should be giving you over here. I will just check if I'm not able to recollect anything now. I will just think about this and I'll give you some explanation next time. Okay. Duration of perpetuity. Right now, you just take this formula. Okay. Then the next one, between coupon dates, if the YTM of a coupon bond remains constant, its Macaulay duration decreases smoothly with the passage of time and then goes back up slightly at each coupon payment date as the time to the next coupon resets to a full coupon period. Between coupon dates, if the YTM of your coupon bond remains constant, that means between coupon dates. So there is one coupon date here, there is one coupon date here. Okay. Its Macaulay duration decreases smoothly with the passage of time. And then, so it means like this. Okay. Macaulay duration, imagine once interest is paid, then the Macaulay duration okay, between coupon dates, if the YTM of your bond remains constant, its Macaulay duration decreases smoothly with the passage of time. And then goes back up slightly at each coupon payment date. Okay, so how do I draw this now? Between coupon dates, if the YTM of your coupon bond remains constant, its Macaulay duration decreases smoothly with the passage. If the YTM of your coupon bond remains constant, Macaulay duration decreases smoothly with the passage of time and then goes up slightly at each coupon payment date. Okay, so that means see, it is slightly, it will go like this. Let me see if it is there in the curriculum. I can show it to you directly. That picture, I have seen it, but I don't know if it is there in this year's curriculum. So let me just see. Fixed income. This is the one. Macaulay duration between coupon payments with constant yield to maturity. So you see, this is the payment date, coupon payment date. So it is coming down, payment date, and then slightly it is further going up. Why so? Because see, it works like this. Now, because the interest payment you are going to get, so the duration is coming down slightly. Why? Expecting that the interest is coming down. Interest you are going to get. Once you get the interest, now the next one, okay, next it will slightly go up. Why? Because why it is slightly going up? Because further next interest rate is far away. Then it will further come down. This is the point. Actually, this is the graph.
So can you explain it again?
Yeah. So this is the graph for this explanation between coupon dates. So see here. Now there is interest payment here and here. So now now this Macaulay duration is slowly coming down. Why it is coming down? Because it is expecting a big payment over here. And once that payment is done, when is the next payment? Next payment is far away now. Next one. So slightly it will increase. And then it will expect the coupon payment. So it will slowly come down. Then next one, it will slightly increase. Immediately after the payment, it will slightly increase. And then it will keep coming down. Okay. This is Macaulay duration between coupon payment dates.
Like the return is
okay
going
now?
to come down, right?
Huh?
So let's say from first year till fourth, the return would be much higher. Is it that? And from third
No,
till
duration
fourth,
means it is approaching, right? Duration means weighted average time, right?
yeah.
So when there is more coupon, it will come, it will approach faster. So because of more coupon expectation, it is approaching, it is low, it is getting down, it is going down. Then, but further
Yeah.
it goes up because the next coupon date is far away. Okay.
Okay.
Then slowly it expects coupon, then the Macaulay duration comes down. Okay. Then the next one, just read this part now. This I think we have done in those 5 points.
Yes, sir, we've done this.
Yeah. Then for your floating rate bond, Macaulay duration is equal to the next reset date. Because remember, your floating rate bond will be repriced to par at every reset date. Your floating rate bond, you can note down this point, your floating rate bond will be reset to par value. Okay. The floating rate bond will be reset to par value at every reset to par value at every reset date. Okay. Reset to par value at every reset date. So that means if there is a floating bond every year, let's say the interest rate is changing. So that's why expecting based on, because see, this interest will be paid this year. This you can you understand? This if it is 2%, 3%, so 2% will be paid here, and then when it is 3%, it will be paid next year. Is this okay?
Yeah.
So that means this bond will expect 2%, and then slowly when the this date comes, it doesn't know what is going to be the new interest rate, so it will go to the par value. And then once the new interest rate comes up, then again further it will behave like a new bond which is expecting 3%. Then again it will reach to the par value. Then again it will be repriced to par, and then it will behave like a new bond. Maybe the new interest rate is 2.5. Then it will behave as if a new bond with coupon of 2.5. So every time it will reprice to the par value. Okay. Is it okay? So what is the Macaulay duration of a floating rate note? It is equal to the next coupon reset. That means if it is yearly reset, then 1 year. If it is quarterly, then it is 1 quarter. That is the Macaulay duration. Is it okay?
Yes.
So,
Yeah, this also I think we have done. Yeah, this also done. Is it okay? Are you able to understand? See, other things equal, and increasing a bond's YTM will decrease its interest rate risk. Because if YTM is very high, will decrease its interest rate risk. That means to understand this, we can look at the convexity of the price yield curve and use its slope as our proxy for interest rate risk. At lower yields, the price yield curve has a steeper slope, indicating the price is more sensitive to a given change in yield. An increase in your bonds YTM will decrease its interest rate risk. An increase in your bonds YTM. YTM will decrease its interest rate risk. So when will the YTM go up? First of all, when the bond price is coming down. An increase in your bonds YTM. That means when the bond price is coming down, then only YTM will go up, right? Will decrease its interest rate risk. Or you can think like this also. An increase in your bonds YTM means the interest rate is going up. Let's say a 5-year bond. Okay. So 5-year bond. Let's say this is also 10%. So present value will be what? 100 now. because these two are same. Present value will be 100. Now increase in YTM, you know, when will YTM go up now? When the interest rate in the market is going up. Imagine you are staying with the bond till maturity. So what will happen then? If the interest rate goes up by 11 percentage, what will happen to the YTM? YTM will go beyond 10 percentage.
Yeah.
Okay, Shravani, have you understood?
Yes, sir.
Huh?
Yes.
Yes, or you want to check? It's just the same thing. Like, see, right now it is 10 percentage, right? 10 percentage, 100, 100, 100, 100, 100, and then 1000. Now they will reinvest at what rate? 11 percentage. If they all are reinvesting at 11 percentage, what will happen at the end? You will get more than 10 percentage, right? Clear, right? Both of you are fine, right?
Yes,
Yes,
understood.
sir.
So that will decrease your interest rate risk. Okay, an increase in your bonds YTM will decrease its interest rate risk because you are reinvesting at the higher rate. To understand this, we can look at the convexity. So here they are explaining convexity of the price yield curve and use its slope as our proxy for interest rate risk. As at lower yields, the price uh, yield curve has a steeper slope, indicating that the price is more sensitive to change in yield. The price is more sensitive to a given change in yield at lower yields. That means at lower yield only, when the interest rate is going down. Okay, so that means if you are staying with the bond for a long period of time, and when the interest rate is going down, okay, then it is more problematic for you. Okay, if you are a long-term investor, and if the interest rate is going down, okay, interest rate is going down, then you will reinvest all at the lower rate. Okay, so that all at the lower rate, and also all at the lower rate. At lower yield, the price yield curve has a steeper slope. So steeper slope means what? This is 10 percentage, and this is, let's say, 1000. At lower yield, it should go till here, but it is going up. It has a steeper slope, indicating that the price is more sensitive to a given change in yield. Okay, at lower yield, it is more sensitive. Okay, but otherwise, an increase in your bonds YTM will decrease its interest rates risk, or a decrease in your bonds YTM will increase its interest rate risk. Okay, that means sensitivity will be, I mean, is this fine or not, this paragraph?
Yes,
No,
understood.
fine. Okay.
Yes.
See this module quiz. These are all sums. Okay, so you please do at home, and then please let me know. I don't see you people asking me any doubts in module quiz. In case if you get doubts, I'm hoping that you are doing it. Okay. In case if you are not
Yes,
doing,
I'm
you are
doing.
taking a huge risk. If you are taking a very big risk, if you are not doing, it will be a blunder. Okay. Yeah, reading 58 now. This is all now repetition. Now it's all over only. This we have already done, right?
Yes.
Convexity. So I'm just now running fast now. Now all these are done. Convexity. So convexity is just the formula. This one, this formula. This is what we did, right? V minus plus V plus minus 2V0 divided by V0 into delta YTM square. Then this is full change. Okay. This also we did, right? This one. All these are done, right? Total convexity and durations.
Yes.
Yeah. The duration only based estimate of the increase in price resulting from a decrease in yield is too low for a bond with positive convexity. Okay. The duration only based estimate of the increase in price resulting from a decrease in yield is too low for a bond with positive convexity and is improved by positive adjustments for convexity. Duration only based estimate of the increase in price resulting from decrease in yield is too low for a bond with positive convexity and it is improved by positive adjustments. The convexity adjustments to the price change is the same for either an increase or a decrease in yield. The duration only based, okay, yeah, convexity is same for an increase or decrease in yield. Can you understand this line? Remember when we were doing sums last time, be it increase or decrease, the right hand side of the change in price, that change in bond price, this was our formula, right? Duration into delta YTM plus half of convexity into delta YTM square. So convexity B, you put minus or you don't put minus. This right hand side remains the same. Understood or not? That means when let the interest rate go up or down, right hand side remains the same.
Yeah.
Is it okay?
Yes.
Okay. As illustrated in figure 58.2, the duration only base estimate of the price increase in price resulting from a decrease in yield is too low for a bond with positive convexity. That means without convexity, it is too low. It is too low, right? Because of the convexity, it is jumping up, and it is improved by a positive adjustment for convexity. The duration only means only duration we are thinking without convexity. The duration only based estimate of the decrease in price resulting from an increase in yield is larger. That
So
means
convexity of the both the sides are same, sir, right?
yeah, convexity is same and both the sides it is benefiting you. How it is benefiting? See, when the
Yeah.
interest rate is going down, your bond should go up to 88.109, but it is reaching to 88.127. That means higher number.
Right.
Similarly, when the interest rate is coming down, the bond should reach to 85.074,
But then
but
it
it
is
is
at
reaching to 85.
0.92.
So both the
Yeah.
sides, if the interest rate is going up or down, convexity supports you. Okay, convexity supports both the sides. Let the interest rate go up or let the interest rate come down. Is it okay?
Yes. Yes.
So what do they mean by positive adjustment of the convexity?
Yeah, positive adjustment means see it is lifting the price up when the interest rate is coming down, which is positive for the investor. Similarly, when the interest rate is going up, it is not allowing it to go down, which is also positive for the investor.
Okay.
Both the side it is positive for the investor. No?
Okay.
Should I write this and explain? See. See, the price should go, when the interest rate comes down, it should go to this much only, but it goes this much. So what is this? Duration effect, positive, and when the interest rate goes up, the price should come this much. When the interest rate is going up, the price should come this much, but it is coming till here up, which is good. So both the sides it is benefit, no, for the investor. So when it is supposed to go down, it is not going down. When it's supposed to go up, it is going up highly. That's why positive. Okay. Then this is a normal case. Portfolio duration. Duration means weighted average duration portfolio. So weight 1 duration. This is a weighted average. Weight 1 duration 1 plus weight 2 duration 2. If there are two bonds, this is the portfolio duration. Then parallel shift. Only under this assumption of a parallel shift in the yield curve will portfolio duration and convexity calculated with this approach produce a percentage change in portfolio value per 1% change. Okay. So our one limitation of this approach is that it assumes so that this is the limitation of duration, that it assumes YTM of every bond in the portfolio must change by the same amount. See, parallel shift means what? Parallel shift as in parallel shift means if this is the yield curve, this is the yield curve. Okay, this is yield and this is maturity. So this is for different time period. Okay, 1, 2, 3. Now so now this is the yield curve. Okay, so this is the interest rates. Okay, now it assumes if the interest rate is going up by 0.5 percentage, okay, 0.5, then everywhere it is going up by 0.5. So this will be the new yield curve. Is this the right assumptions? No. Practically, how will it happen? Practically, it will go this direction. Here it is highly impactful. Here little lower. Here little lower, lower, lower. So it will move like this practically.
This changes because of the discount.
No, for longer period, the effect will be lower. For longer period, because see, when RBI is increasing the repo rate or decreasing the repo rate, it is the short term which will get highly impacted first.
Yeah.
Long term will not get highly impacted. That's why when you see when repo rate is increased or decreased by 50 basis points, the 10-year yield will move only by few basis points. The 10-year bond yield will move only by few basis points. Okay. So this is called key rate duration. That we will see. That topic is there. Key rate duration. That means it will capture the shaping risk. So it will capture this is called shaping risk. Okay. different, it is taking different shape, it is not parallel. Okay, so which is more realistic? Okay, will capture shaping risk. It will capture shaping risk. Okay, parallel shift. Remember, this is a very important point. So this is the limitations of duration, that it is, that's why remember I said approximate change in price, duration.
Yes.
Remember, that is because of this reason only, because it is not accurate. No? It is assuming parallel, which is a wrong assumption. Wrong assumption. That is why, it will tell you only the approximate change. It is not an accurate one. Okay. 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 See this one now. Yeah, convexity. Negative convexity. While the convexity of any option-free bond is positive, a callable bond can exhibit negative convexity. So for any option-free bond, convexity is positive. That's what we have seen. But for callable bond, it is negative. Why is it negative? Uh, while the convexity of any option-free bond is positive, a callable bond can exhibit negative convexity. That means, see, imagine this is 10 percentage, this is the price, and this is the yield. So this is 100. Now when the interest rate comes down, the price should go up. Okay, this is 110. Now because of convexity, it goes to, let's say, 120. But then let's say the company said it is callable at 115. When the company said it is callable at 115, then the convexity, which should be like this, will move this way. It will not cross 115 because it is callable. That means the company itself is saying that I will not pay you more than 115. Then the market also will not pay. So convexity for a callable bond is negative. Okay, you can write down very important point. Convexity for a callable bond is negative. Whereas for any option-free bond, it is positive. Is it okay now?
Yes, sir. So what was the point that you said to write down?
Convexity for a callable bond is negative.
Okay.
Whereas for any option-free bond, it is positive. Is it okay? Fine. Okay. This is because at low yields, the call option becomes more valuable. Okay. More valuable. And the call price puts an effective limit on increase. So it is more valuable only, but the call option puts limit. This is what it means. Okay, and then see this line. For your bond with negative convexity, the price increase that results from a decrease in YTM is smaller than the price decrease that results from an equal sized increase in YTM. They like asking this kind of, this kind of words they like using. So they may ask. This means the duration of a callable bond is less than that of an equivalent option-free bond at lower yield. This is the meaning. For callable bond, duration is less, right? It should move this much, but it is less only. Duration change is less. It should come here, but it is stopping here. Is it okay? Fine.
Yes.
Yes.
Okay. Now, what if it is a puttable bond? Puttable bond, it is always positive convexity. Okay. Always positive convexity. Why always positive? Because when the interest rate is going up, the bond price will come down. But here, it is supposed to come to 90. But company said they are ready to buy at, let's say, 105. Not 105, let's say 95. If they are ready to buy at 95, then it will never come below 95. Because company itself has said that they are ready to buy at 95. So it is positive. If it is puttable bond, it is even more positive only. Okay. Let's read all this. The next one, shaping risk. Okay, this is key rate duration that I was speaking about, which is also called as partial duration. Okay. How to exactly calculate key rate duration? Okay. Just we'll do this sum, then we will do one proper key rate duration sum also. Just have you read this part? Just read all this highlighted one. Is it okay? Fine. Okay. Or I think uh, otherwise we can stop also here. We can begin from key rate duration tomorrow then. Okay. I'll do this some
So
tomorrow.
can we have a can we continue from Monday?
Monday? Ah,
Yeah,
okay
tomorrow
then.
and
Okay then.
be
Let's not
off.
have it tomorrow. We'll do it on Monday then. Okay.
Okay, sir. Yeah.
Yeah. Okay then. Okay. Bye.
Thank you, sir. Bye,
Okay.
sir.
Bye.